5 financial ratios you should follow on a company. Now, these 5 financial ratios are kind of a first level of filter you can put in so that you understand what kind of companies to deep dive into. So this is just a first filter, but it's a most important filter. What are those 5 metrics? First one is sales growth. Growth is the reason why somebody would invest in companies, right? We all invest in businesses for growth, and growth is the most important thing. Now, growth, when I say it is most important growth, is a sales growth or revenue growth. That is a real reflection of growth of the company. A company can always squeeze in the operating metrics. It could squeeze in the cost, put in some cost optimization, bring in some efficiency, productivity, etc. But those can help in the operating level and the bottom line level of profitability, and that kind of a growth is more at the bottom line level, which is also important. But first, growth at the top line level, which is the sales growth or revenue growth, most important metrics. Second important metrics is the total addressable market. The total addressable market is actually a reflection of the growth, right? So a company can grow only into the space that is addressable, only into the market that's addressable, or it has to be a completely innovative space which is nascent. Now, it's important to understand how much is addressable growth, or so-called TAM, the total addressable market. Total addressable market is a measure used by many of the venture capitalists out there, especially the companies which are in the new nascent or sunrise sectors, right? So TAM is a very important measure as well. The third important measure is profitable growth. Now, when I say profitable growth, there is a combination of 2 things. You need to take into account the margins, which is the gross profit margins, operating margins, and the net profit margins. All 3 are important, but typically you see a company that is in explosive growth, like 70, 80, 100%, they will not have a profitable growth. Whereas at that point of time, it's a good idea to check the gross profit margins and how much sustainable the gross profit margins are. Is the company sustaining those margins, and is it expanding, which is another important metric. You always understand the stock market investors rewards the company that is expanding its margin, at least sustaining its margin, right? So gross margins, when it's explosive growth, when the growth slows down, becomes a high growth from an explosive growth, the operating margins comes into the picture, because the operating leverage kicks in, the operating profits comes in, and you need to look at the operating margins. Now, how do the operating margins flare? Will it sustain over a long period of time? Is it improving? Is the company bringing in efficiency? Is the company bringing in productivity improvements, automation, many other ways, right? Cost optimization, etc. Is the company doing all that and continuously expanding margins? Now, margins is just one aspect of profitable growth. The other aspect is return on invested capital, or return on capital employed, or return on equity. All 3 are kind of correlated. That is an indicative figure which illustrates that the company is growing profitably, right? There's a profitability, and return on equity, ROE, is a profit on top of the equity that is in the balance sheet. Very simple to calculate. You can deep dive. Operating profits on top of invested capital, that is a total invested capital by the company, will consider the debt factor, and it will give you the total operating returns at the invested capital level. And the final one, return on capital employed, pretty much like an invested capital, but it addresses the total capital that is employed, but at operating level, right? So it's also called NOPAT, net operating profit after tax. So those are very deep dive. You can take my free courses out there, it's in the description, and all the courses are free. I have 14-hour game of investing course. It delves deep into how to arrive at these metrics, how to calculate them, how to do valuation and everything, right? So that's a different topic, but at this juncture, you need to know these are the third filter, which is a profitable growth. The fourth filter is debt to equity, which is very important as well. The debt to equity shows how strong the balance sheet of the company is, how much cash it has, how much liquidity it has with respect to the debt, and how much debt it has with respect to short term and long term, right? So is the company in a position to service those debts on request, and is the company liquid enough, and all those measures you need to arrive at. There are different ratios for that: liquidity ratio, solvency ratio, current ratio, and all that. But at this juncture, you need to know the most important first level of screening. We are just talking about first level of screening is debt to equity. Debt to equity is how much debt the company carries and in the balance sheet on top of the equity that the company has in the balance sheet. So both are a measure of balance sheet, and you can easily do that ratio. Typically it is good ideal to have a ratio less than 1 or thereabouts. There are companies which are heavy, depend on capex heavy companies, for which a ratio 1.5 to 2 up to that level could be could be okay, because financial leverage can help show higher growth for the companies, right? Higher return equity as well. So debt level, nominal debt level is good for the companies, and if it is in the controllable limit, it's even better. So look at that ratio. Now finally, a valuation metric called price to sales or price to earnings. Now I'm not a fan of PE ratio, price to sales ratio, to just depend on that and go for an investment from a valuation standpoint. There is much more. I have dedicated a complete session in my course for valuation. But at a first level of filter, a PE or a PS, price to earnings or price to sales, gives you a reflection of how much the market is pricing in the future growth of the company, or is the hyper growth already priced in the price to sales ratio or price to earnings ratio, which typically will be. But because the markets in today's information era, the PE ratio and PS ratios typically remain elevated if the growth is high, or if the quality of growth is pretty good, which means higher return on invested capital and high profitable growth with strong moat or strong pricing power, then the quality will demand a premium pricing, right? So those will have higher price to earnings ratio. So this is with respect to relative, the PE ratio and price to sales, how a company of the similar market, similar industry is priced in by the market, how the growth is flaring up against those companies, and when typically the market goes depressed, the price to sales, price to earnings ratio goes depressed. And believe me in this one thing, the multi-bagger returns are created when there is two things that happens: when there is an expansion of price to earnings or price to sales ratio, which is a price multiple ratio. If that expands and the earnings compound, right, these two combination will create you multi-bagger returns. But a price earnings ratio expansion or price to sales expansion is a critical, most important factor when it comes to creating multi-bagger. Otherwise you have to depend on only the earnings growth compounding, right? So this kind of gives you a good indicative level of, first, these 5 filters will give you an assessment of how good the company is, and then you can deep dive to see the sustainability, optionality, management strength, the profitable growth, margin expansion, all those factors as a deep dive. But this due diligence at least somebody should do before investing in a company. Trust this was helpful. Signing off, Sandeep Anand.